9 common valuation ratios when it comes to stocks, stock market, and how it impacts your wealth right here, right now. So you're looking at stocks, you're wondering, how do I know what these valuation metrics are? Which ones are important? How do I know where to focus my energy on? You don't know. There's so much information out there. We're going to try to break it down for you so that you know which ones are important, which ones you should follow, and what do they mean. So let's start with the first one, probably the easiest, the market cap. Market capitalization of a company. Now, we've talked about this in the past, but it simply means, so your market cap is equal to shares outstanding times share price. That's it. That's simple. That's how much the company is worth. If someone were to buy that company today, they'd have to pay at least that much for the company. Typically, they pay a premium, 20, 30, 40% more than the market cap in the market to acquire the entire company. Second valuation ratio. Free cash flow. How is your free cash flow metric measured? It's your cash flow from operations minus your capital expenditures. So your free cash flow, when you're looking at financial statements, is really the total cash flow that's been generated from the operations, and you deduct your CapEx. CapEx is how much capital you're expending on projects inside the company. For oil and gas companies, it might be expending money on, new exploration and wells and something. For companies that are growing, it might be kind of more buildings and land, etc., but it's capital that you're spending on the company. Now let's move to the income statement. The next few ones that we're going to look at are numbers and metrics that you're going to find when you are looking at the income statement of a company. All right, so the income statement is reporting the net operating income or the income of the company. And this one that we're looking at, price to sales ratio. It is the market cap of the company or the total value of the company divided by the total sales. This number is going to tell you at what multiple the company is trading of its sales. Now, the price to sales ratio is typically going to be used to evaluate companies that are not yet profitable. Because if you have a profit, then you can measure a different multiple, which would be price to earnings, which is probably more valuable. But if you have a strong, growing company that isn't yet profitable, you've got to figure out a way to measure that company. So they use price to sales, and they use that as a multiple. How much are we getting for each dollar of sales for this company? So a price to sales ratio, a good one, will depend on the industry. Companies that have higher margins will trade at a higher price to sales ratio than companies that have lower margins, right? Imagine you're making $1 of earnings and you're making 30% margins, right? So now you've made 30 cents of profit. That 30 cents of profit relative to the $1 of sales is worth a lot more. So your multiple on sales should be higher. And if you have a company that's making lower margins, like grocery stores, for example, then you're going to get a lower multiple on sales. Generally, the multiple on sales is anywhere from kind of half of 1 to, let's say, 10 for the majority of the stocks. And as you get into high growth companies, very high growth companies that are not profitable, and in euphoric times, you can get into situations where that number balloons to 20, 40, even 100 times sales. It's happened before, and it typically is a sign that the market is starting to get a little frothy, or people are getting a little excited about stocks, maybe too excited. Next, we have price to gross profit ratio. Okay, so this ratio compares the price you pay for shares of a company to a company's gross profit. The money left after subtracting the cost of goods sold, so your COGS, from the revenue. Most commonly, your price to gross profit is measured in a 1 year of gross profit number. Next, we have your price to EBITDA ratio. That ratio is the market cap of the company divided by your operating income, otherwise known as your EBITDA. Your price to EBITDA ratio measures, it's a pretty significant measure, and they use it quite a bit. It measures a financial metric. It measures the relationship between a company's market cap, so the total value of the market cap, and its earnings before interest, taxes, depreciation, amortization. And that becomes a ratio. Next ratio we're looking at is price to EBIT ratio. Now, this one is similar to EBITDA, although we kind of chop the last two letters, and we're looking at earnings before interest and taxes. So just kind of that portion. Again, you're going to have your market cap. It's going to be divided by that number, your EBIT. It's going to be a multiple, and you're always looking at a multiple. Number 7, we're looking at price to EBT ratio. Now, we've now stripped out the interest portion of it. So really, it's going to be the market cap of the company, the market capitalization, divided by the earnings before taxes. That's it. Just your straight up earnings before taxes. We're getting close to your earnings ratio, which is the next one that we're looking at right now, number 8, price to earnings ratio. This is probably the most common metric that you've looked at in earnings. Whenever you're looking at a stock, you're analyzing a stock, you want to know price to earnings. How much are we paying for each dollar of earnings? $1 of earnings, what kind of multiple are we paying for that? Are we paying 10 times? Are we paying 20 times? Are we paying 50 times? There are companies in extreme high growth that will trade at a significant multiple, 40, 50 times. The S&P 500 has traded historically kind of in the 15 to 20 range, but it can go a lot lower in times of market turmoil. It can go a lot higher in times of market euphoria. And this is your typical multiple. If you're watching BNN or if you're watching some sort of American stock channel, they are talking about earnings multiple. They'll often tell you it trades at a great multiple, or it trades at a cheap multiple, or an expensive multiple. When they're talking about that multiple, they are referring to the price to earnings multiple. A nice way to remember it is this earnings here is your total net income. So market cap divided by your total earnings as a net income gives you your price to earnings ratio. Finally, the last metric we'll look at for stocks, number 9, we're going to look at price to free cash flow. So this is, again, the price of the company, the market cap, divided by the free cash flow. You're looking at the cash flow statement. You want to know how much free cash flow has been generated, and you want a multiple of that. How many times are we trading? What kind of multiple are we paying for each dollar of free cash flow? The higher the multiple, the more that company is sought after, and the lower the multiple, the less appetite there is for that company. There you go, guys. If you're unsure how this or anything else can apply to your portfolio, if you want someone to handle this, you don't really know much about this, but you want a professional to handle this, go to speaktorob.com to book your no obligation consultation to chat with me or someone from my team about this very topic. Speaktorob.com, guys. Thanks for tuning in. I'm Rob Tetrault. I'll see you in the next video.